This video is for general educational purposes only and should not be considered financial advice. Investing involves risk, and you should always do your own research before making investment decisions. In the last video, we learned that a call option gives you the right to buy an asset at an agreed price before a certain date. Today, we're looking at the opposite. A put option gives you the right to sell an asset at an agreed price before a certain date. Even if you haven't watched the call options video, don't worry, we'll explain everything from the beginning. And just like before, many people find it easier to understand put options by using a house instead of shares. Imagine your house is currently worth $500,000. You're worried that property prices might fall over the next 6 months. A friend offers you a legal contract. The contract says that in exchange for $5,000, they guarantee they will buy your house for $500,000 at any time during the next 6 months if you decide you want to sell. That agreement is called an option contract. You are paying for the legal right to sell your house at an agreed price before the contract expires. Notice something important. You don't have to sell your house. If property prices rise to $600,000, you would simply ignore the contract and sell your house on the open market instead. You would only use the contract if property prices fell below $500,000. For example, if property prices drop to $450,000, you could still use your contract to sell the house for $500,000. That means the contract has protected you from part of the fall in value. This is why many investors think of put options as a form of insurance. Now let's replace the house with shares in a company. Instead of owning a house worth $500,000, imagine you own shares worth the same amount. Instead of protecting the value of your house, you want to protect the value of your investment. A put option works exactly the same way. It gives you the legal right, but not the obligation, to sell your shares at an agreed price, called the strike price, before the contract expires. Just like the house example, if the market price stays high, you simply ignore the contract. But if the share price falls below your strike price, the put option becomes valuable because it allows you to sell at the higher agreed price. Just like call options, one standard stock option contract usually controls 100 shares. There are two common reasons investors buy put options. The first is protection. Imagine you've built up a large profit in a company, but you're worried the share price could fall over the next few months. Buying a put option can act like insurance. Even if the share price falls sharply, your put option gives you the right to sell your shares at the higher strike price. The second reason is speculation. Some traders believe a company's share price is going to fall. Instead of short selling shares, they buy put options. If the share price drops, the value of the put option may increase. In this beginner video, we're simply explaining how put options work. We'll cover more advanced strategies in future videos. The strike price works exactly the same way as it did with call options. It's simply the agreed selling price written into the contract. If your put option has a strike price of $100, that means you have the right to sell your shares for $100, regardless of what the market price is. With put options, these terms work in the opposite direction to call options. If the share price is below the strike price, the option is in the money because you can sell for more than the current market price. If the share price is exactly the strike price, the option is at the money. If the share price is above the strike price, the option is out of the money because selling at the strike price offers no advantage. Just like call options, put options can have intrinsic value. Intrinsic value is simply the difference between the strike price and the current share price when the option is in the money. For example, if your strike price is $100 and the shares are trading at $90, the option already has $10 of intrinsic value per share. However, the option premium will often be worth more than that because there is still time remaining before the contract expires. That additional amount is called time value. So an options premium is usually made up of two parts: intrinsic value and time value. Every put option has an expiration date. After that date, the contract no longer exists. As the expiration date gets closer, the amount of time remaining on the contract becomes smaller. Because there is less time for the share price to move, the option gradually loses its time value. This gradual loss of time value is known as time decay. Time decay happens every day and generally speeds up as the option gets closer to expiration. Professional traders often refer to time decay as theta, one of the option Greeks. Don't worry about remembering that for now. We'll cover the Greeks in a future video. If an option has no intrinsic value by the expiration date, its remaining time value disappears completely, and the option will usually expire worthless. One important thing to remember is that even if the share price doesn't move, the value of an option can still fall simply because time is passing. A put option gives you the legal right to sell your shares at the strike price before the option expires. Actually, exercising the option means using that legal right. Let's look at an example. Imagine you own 100 shares in a company. Your put option has a strike price of $100, but the shares have now fallen to $80. If you exercise your put option, you can still sell your 100 shares for $100 each, even though they're only worth $80 on the open market. That's the protection the put option provides. However, many investors don't actually exercise their options. Instead, they simply sell the put option itself if it has increased in value. Selling the option is often simpler because you don't need to complete the process of delivering the shares under the option contract. For many investors, selling the option achieves a similar financial result while avoiding the extra steps involved in exercising. Remember, to exercise a put option in this way, you generally need to own the shares that you're selling. In this beginner series, we're focusing on buying put options for protection. We'll cover more advanced uses of put options in future videos. One of the biggest advantages of buying put options is that your maximum loss is generally limited to the premium you paid for the option. If the option expires worthless, you can lose the entire premium. But unlike some other option strategies, you can't lose more than that from simply buying the put option itself. Knowing your maximum possible loss before you invest is one reason many beginners start by learning about buying call and put options before moving on to more advanced strategies. Let's quickly recap. A put option gives you the right, but not the obligation, to sell shares at a predetermined strike price before the expiration date. The strike price is the agreed selling price. The premium moves up and down just like a share price. A put option gains intrinsic value when the share price falls below the strike price. Time value gradually disappears through time decay as the expiration date approaches. Many investors choose to sell the option rather than exercise it. And when you buy a put option, your maximum loss is limited to the premium you paid. If you'd like to learn more about stock options, including practical examples and more advanced strategies, I've written a book called Profitable Stock Options Trading. It covers many of the concepts we've introduced in this video and is designed to help you build your understanding step by step. You'll find a link to the book in the video description below if you'd like to learn more. If you found this video useful, please click the subscribe button. It costs you nothing, but it really helps the channel. Thanks for watching, and I'll see you in the next video.